When you look at a price chart, what do you actually see? Most traders see candles. They see patterns forming. They see lines they drew last night that price ignored this morning. But every single one of them is missing the most important piece of information on the entire chart. Not an indicator, not a moving average, not RSI, volume. And in this video, I'm going to show you how to read it correctly, not what volume is, what it means, why it changes everything about how you read a chart, and exactly how to use it to see what's really happening behind every single candle. By the end of this video, every candle on your chart will tell you a complete story, and volume will be the proof, not financial advice, just education. Let's get into it. Here's what most traders get completely wrong from the beginning. They treat price and volume as two separate things. Price goes here, volume bar sits below, two different pieces of information that occasionally line up. That is the wrong mental model entirely. Price and volume are not two separate things. They are one conversation happening simultaneously. Price tells you what happened. Volume tells you whether it was real. Think of it like a courtroom. Price is the testimony. Volume is the evidence. A witness can say anything. But without evidence behind it, the testimony means nothing. You would not convict someone on testimony alone. And you should not trade on price alone. Here's the framing that changes everything. Every chart speaks two languages at exactly the same time. Language one is price. Price tells you what happened. Did the market go up, down, sideways? That is the headline. Language two is volume. Volume tells you how much conviction was behind that move, how many traders participated, how much real money actually moved. That is the evidence, the proof behind the headline. Think of it like an election. Price is the result, who won, but volume is the number of voters who showed up. If 10 people voted, does the result actually mean anything? But if 10 million people voted, that is a declaration. That is real. Same with the market. A big green candle on low volume is suspicious. A big green candle on high volume is conviction. From this point forward, every time you look at a chart, don't just ask where did price go. Also ask how much money stood behind that move. Those two questions together give you the complete picture that price alone never can. Now here is the single most important idea in this entire video. The one mental model that makes everything else in volume analysis make sense. It is called effort versus result. In the market, effort is volume. How much energy, how much money, how much participation is being used. Result is the candle. How far price actually moved as a consequence of all that effort. Think of it like pushing a car up a hill. Your foot on the gas is the effort. How far the car actually moves is the result. When effort and result match, the move is real. When they don't match, something important is happening beneath the surface. This one framework explains every meaningful volume signal you will ever see. So let's go through each case carefully. Case 1. High volume, big candle. Effort matches result. Everything is aligned. Lots of buyers, lots of conviction, price moved significantly. That is a genuine move. Healthy, real, and likely to continue. Like a stadium full of people all standing up to cheer at exactly the same moment. That is genuine excitement. Not manufactured, not manipulated, real. Case 2, high volume, small candle. This is where most traders get confused. The volume is massive, the biggest bar in weeks, but the candle barely moved. This is absorption, and this is one of the most powerful signals in all of volume analysis. What is actually happening? One side is pushing hard, but there is an invisible wall on the other side. A large player, a fund, an institution is sitting there quietly absorbing every single order being thrown at the market. Think of a dam. The water keeps pouring in with enormous force, but the dam holds everything back. The water doesn't go anywhere. When the water finally runs out, when buyers exhaust themselves and there is nobody left to push price higher, price drops sharply, because the wall was never gone. It was just absorbing. High effort, tiny result. That mismatch is your warning. Case 3. Low volume, price still moving. This one surprises most traders. If volume is low, how is price moving at all? The answer is the absence of the other side. This is called no supply or no demand depending on the direction. When price moves up on low volume, it doesn't necessarily mean buyers are exceptionally strong. It means sellers are absent. Nobody is selling. So the market doesn't need much effort to move upward at all, like walking down an empty corridor. You're not moving fast because you're powerful. You're moving fast because nothing is blocking your path. This signal tells you the path of least resistance is clear. Let's put these three cases into a simple matrix you can use immediately. High volume plus big candle equals healthy move, real participation. High volume plus small candle equals absorption. Someone is holding price back. Warning sign. Low volume plus price still moving equals no supply or no demand. The other side is absent. Path is clear. Memorize these three combinations. They are the foundation of everything that comes next. Now let's apply effort versus result to specific candle patterns that every trader should be able to recognize. This is volume spread analysis in practice. And there are 4 patterns worth understanding deeply. Pattern 1. Stopping volume. Imagine price has been falling for days. Red candle after red candle. Panic is spreading. Everyone is selling. Then you see this, a tall red candle. The volume bar underneath is enormous, the biggest in weeks, but the candle doesn't close at the very bottom. It has a long wick below, and the close is near the middle of the candle's range. What happened there? Someone with significant capital bought everything the panicking sellers were throwing away. They didn't slow the selling with words or signals. They slowed it with money. Massive buying absorption at the bottom. High effort, small downward result, close well off the lows. That is stopping volume. A potential reversal zone is forming. The selling may not be over yet, but the first evidence that something is changing has just appeared. Pattern 2. Buying climax. Now flip the scenario entirely. Price has been going up for weeks. News is positive. Everyone is bullish. Retail traders are jumping in because they don't want to miss the move. Then you see a huge green candle. Volume is extreme, the highest on the entire chart. Most traders look at this and think massive strength. That is exactly the wrong interpretation. This is not strong buying. This is strong selling disguised as buying. Smart money, institutions, large funds, they are using that wall of retail buy orders to unload their massive positions. They are selling into the demand quietly, without crashing the price, because the retail FOMO is giving them all the buyers they need on the other side. Think of a vendor at a crowded market. The busiest moment, the most chaotic rush, is when they are clearing out the last of their inventory. The moment you jump in at the top because you fear missing out, that may be exactly the moment smart money is walking out the door. Pattern 3. No supply test. After a sustained uptrend, price pulls back slightly. You get concerned. Is this a correction turning into a reversal? Then you look at the volume on that pullback. Small red candle. Volume is very low, almost quiet. The market is asking a question. Does anyone want to sell here? And the low volume is answering, no, not really. That is a no supply test. Sellers are absent. The uptrend has a high probability of continuing, like touching a surface you're worried might be hot. You put your hand near it and feel nothing. Cool, safe to move forward. Pattern 4, effort with no result on the upside. Price is pushing against a resistance level. Volume is high on the push, but the candle stays small. The close is weak relative to the volume. You know what this is. Absorption at resistance. The wall is holding. Someone with significant size is selling into every buy order. Price is not going through that level on this attempt. Be very careful about buying breakouts that look like this. Now here's the single most common mistake in volume reading that costs traders the most money. And if you've been making it, you are not alone. Almost everyone starts here. The myth is this: green volume bar means buying. Red volume bar means selling. That is not how it works. Here is the actual truth. Every single trade in a financial market requires a buyer and a seller simultaneously, without exception. If you buy 100 shares, someone else sold you those 100 shares. Volume counts the number of transactions, not which side is winning. The color of the volume bar simply follows the color of the candle. If the candle closed higher than it opened, the bar is green. If it closed lower, the bar is red. That is the only thing the color tells you. It has nothing to do with who is in control. Think of a busy auction room. The room is packed, high volume, but there are buyers and sellers everywhere. You cannot say today is all buying just because the room is full. Full means activity. To know who is winning, you look at where the closing price is, not the color of the volume bar. The rule is simple. Don't look at the color of the volume bar. Look at the size of the volume bar combined with where the candle closes. Size plus close position. That is where the real story lives. Now let's talk about one of the most powerful warning signals in all of volume analysis. Volume divergence. When price and volume agree with each other, the trend is healthy. Price going up with volume going up means strong participation. Price going down with volume going down means the selling is weakening. Those are aligned states. But when price and volume disagree, that is your early warning system firing. Here's the most important version. Price is making new highs. The chart looks great. Everyone is celebrating, but the volume bars are getting smaller with each new high. Each push upward is happening with less and less participation. Think of a rocket. At launch, the fuel tanks are full. The engine blasts with maximum thrust, but as the fuel burns, the thrust weakens. The rocket slows, and eventually, it falls. That is what declining volume during an uptrend looks like. The move is running out of fuel. Fewer and fewer traders believe in the continuation. The same principle works in reverse. Price falling, but volume also declining means sellers are getting exhausted. Each drop has less participation. The selling is drying up. A bottom may be forming before price has confirmed anything structurally. Volume divergence is your free early warning system. The market hasn't reversed yet, but it is getting tired. Pay attention when you see price making new extremes, but volume making lower extremes in the same direction. Something is about to change. Now let's turn all of this into a practical process you can use on any chart, in any market, starting from your very next trading session. I call it the 5-question volume check. Run through these 5 questions before every trade. Question 1. Is volume increasing or decreasing compared to recent bars? Zoom out first. Get the context. Is participation growing or shrinking in this market right now? Question 2. Does effort match result? Big volume should produce big candles. If it doesn't, someone is absorbing. If a small candle forms on enormous volume, a large player is on the other side of the move. Question 3. Are there unusual volume spikes near key levels? This is the most important question. Anomalous volume at support and resistance is almost never random. Find those spikes and ask what the candle did in response. Question 4. Is volume diverging from price? New price highs on decreasing volume is a warning. New price lows on decreasing volume may signal exhaustion of the selling side. Question 5. What does the next candle confirm? This is the one most traders skip because they are too eager to enter. Never make a final decision based on one candle. The candle that follows a high volume event tells you whether the signal was real. A strong reversal candle after stopping volume confirms the absorption. A weak, drifting candle after a volume spike suggests the signal needs more time. Patience for one additional candle can eliminate the majority of false signals from your trading. Now let's talk about how this connects to the broader market mechanics you may already know. Volume analysis does not exist in isolation. It is the confirmation layer that sits beneath every other concept in trading. Liquidity sweeps look different when you add volume. A sweep on low volume means the move was mechanical. Stop triggers firing, not genuine selling. That is exactly the confirmation you need that the sweep is complete and the real move is about to begin. Support and resistance levels are not equal when you add volume. A level that held on enormous volume is a completely different level than one that held on thin participation. The first has real absorption behind it. The second may simply have had no one to test it. Breakouts that most traders chase become much clearer with volume. A breakout on expanding volume with large candles is a real breakout. A breakout on thin volume with small candles is a probable trap. Volume does not change your analysis. It upgrades your analysis. It takes every concept you already understand and gives you the evidence layer that separates the high probability situations from the noise. Here is the mindset shift that makes everything above actually usable. Stop looking at volume bars as a separate indicator. Start reading them as the proof behind every candle. Price can be pushed temporarily. Price can be manipulated short term. But volume shows you where real money, real commitment, real participation is actually stepping in. When you learn to ask effort versus result automatically, every chart becomes a different experience. You stop seeing random candles, you start seeing transactions, you stop guessing whether a move is real, you start reading the evidence. The volume bar below every candle is not decoration, it is the truth. And once you learn to read it, you will never look at a chart the same way again. Drop a comment. Which of these four patterns have you seen most on your charts recently? Stopping volume, buying climax, no supply test, or the effort with no result signal at resistance? I read every single one. I'll see you in the next video. Stay disciplined.